Today, we're looking at a whole collection of reports, data, analysis, and we're really going deep into what our sources are calling, well, one of the most critical periods for the Florida real estate market in quite some time.
Yeah.
You might think of Florida, sunny days, booming sales, but the picture emerging from 2025, based on this material, it looks quite different.
That's absolutely right. And the sources we've gathered, they don't point to just like one simple problem. It's much more complex.
hmm
It's what experts are calling a perfect storm. You've got multiple factors interacting, hitting the market all at once.
Okay, so our mission here is to unpack all of that. We want to understand the key drivers behind this turbulence, see what the latest data tells us right now,
Exactly.
and importantly, explore what this might mean for you, whether you own property there, thinking of buying or selling, or maybe you're just interested in these big economic shifts. It affects the whole landscape.
It really does. It's a market changing rapidly, significantly. Getting a clear handle on the forces at play, as described in these reports, is crucial.
So where do we start? The data. Let's ground ourselves in the numbers first. What are they telling us about the situation as we're moving through 2025?
Okay, yeah, the data. The overall picture from these sources is pretty stark.
Stark, how so?
Well, analysts generally agree the market's in a significant crisis. Reports are calling it one of the most serious downturns, maybe one of the most critical periods in decades. It's not just a typical market adjustment.
And that term, perfect storm, keeps coming up.
It does, and it's not used lightly. It really reflects this convergence of major negative pressures hitting simultaneously.
And the most visible sign of that, I guess the thing that just jumps out from the data is this explosion in inventory, the sheer number of homes for sale.
Yes, that's a huge one. The numbers are dramatic. If you look at January 2025, statewide, the total number of homes listed for sale hit 179,000.
179,000. How does that compare?
Well, that's a massive 23% increase compared to January 2024.
hmm
And what's really striking is that it's the highest level of active listings they'd seen since way back in 2012, over a decade ago.
Wow, a 23% jump year over year and a decade high. Are other sources seeing the same thing?
Yeah, definitely. Data from firms like Redfin backs this up. Their report for the end of January 2025 showed, I think it was 172,209 unsold homes listed.
Okay.
And Redfin specifically said that's the highest level of unsold inventory they've recorded since they started tracking this data back in 2012.
And it didn't just peak and drop.
No, it kept climbing. By April 2025, reports show inventory rose even further, hitting 180,000 homes. That marks the highest level seen in 15 years. So that's a sustained surge.
15 years. Unbelievable. Are there specific spots where this inventory boom is even more extreme? Give us a local feel.
Absolutely. The sources point to examples to really show the scale. Cape Coral is one they mentioned.
Okay.
Active listings there reportedly more than doubled in just 3 years. Went from about 1,800 homes listed in 2023 to almost 4,000 by 2025. Yeah.
Doubled in 3 years. That's incredibly fast. Where are all these homes coming from? Is it just more people deciding to sell?
It's a mix of things, and we'll get into the drivers more, but one big factor mentioned is the recent construction boom.
Ah, right.
Florida built homes very rapidly, especially between 2021 and 2023, partly because of people moving in during the pandemic, low interest rates. That whole wave of new construction is finishing up now and hitting the market, adding a lot to the supply.
Okay, so a ton more homes for sale, highest levels in years. What about the other side? Demand. Are buyers snapping these up?
No. The data suggests the opposite, actually. While inventory is soaring, sales volumes, the number of actual deals closing are falling.
Okay.
That's a key sign of demand weakening, just not keeping up with all that supply. If you look at April 2025 statewide data, sales of existing single-family homes were 23,572. Still a big number, but it's down 4.5% compared to April 2024.
Nearly 5% drop in single-family sales. What about condos and townhouses?
Even steeper decline there. Statewide sales for condos and townhouses in April 2025 were 8,710 units. That's down almost 15% year over year.
15%. That's a really sharp drop for condos.
It is. So the slowdown is hitting both types, but the condo and townhouse market seems to be seeing a much sharper fall off in activity, according to these reports.
Any specific city examples for that slowdown?
Yeah, they highlight Miami. Reports show that in February 2025, Miami saw only, I think, 307 total properties sold. That was a 7% drop compared to February 2024. So it's not just a statewide average. You feel it in the big markets, too.
Okay, so inventory way up, sales volume down pretty notably. Basic supply and demand says that usually pushes prices down, right?
It does. And the sources confirm that's happening. Housing prices in Florida have officially started to decline. That's a big shift after years of rapid growth.
Started to decline. How much?
Well, the statewide median price for a single-family home in March 2025 reportedly fell nearly 2% compared to the month before. For the whole first quarter of 2025, the median was $414,555. That was basically flat compared to Q1 2024. But that flatness itself, after years of increases, was the sign the trend was turning. Then the monthly data confirmed the dip.
So the yearly comparison looked flat, but month to month, starting March, the drop began. Are some areas seeing bigger price drops?
Yes, definitely. The reports mention places where the correction is more pronounced. Sebastian, for instance.
Okay.
Median price there fell 8.2% to $400,000. Punta Gorda saw a 6.8% drop, down to about $354,000. So some local markets are feeling much more price pressure than the statewide average suggests.
Right. Okay, inventory up, sales down, prices starting to fall, especially some spots, paints a clear picture of headwinds for sellers.
Right.
What about the rental market? Same story.
Yeah, the sources indicate the rental market is definitely struggling too. It's not immune, especially with all the supply. Tampa, for example, is ranked second nationally among metro areas with the biggest rental market problem.
Second nationally.
Reports show an 8% year-over-year decrease in average asking rent in Tampa. Orlando also saw a big drop. Rent's down 6.5% year-over-year.
An 8% drop in asking rent in Tampa. After years of crazy rent hikes, that's huge. How does that hit landlords?
Well, this is where it circles back to the sales market. The sources say with rents falling, but ownership costs like taxes and insurance soaring.
Which we'll get to.
Right. Many landlords just can't cover their costs anymore with the rent they're getting. And that's reportedly forcing some to sell their investment properties. Sometimes they even have to take a loss just to get out.
So stressed landlords are adding more supply to the already high inventory of homes for sale.
Exactly. It compounds the problem.
Okay, that gives us a really good overview of what's happening based on the numbers, supply surge, demand drop, price dips, rental struggles. Let's pivot now to the why. What are the key factors, the ingredients in this perfect storm that the sources point to?
There are several big ones, all interconnected, but maybe the most fundamental, the most direct brake on buyer demand is mortgage rates.
Right, the cost of borrowing. Where are rates now, according to these reports?
As of June 2025, the typical rate for a 30-year fixed is hovering around 6.75%. For a 15-year fixed, it's about 6.01%.
Okay.
Earlier in 2025, they were slightly higher, like 6.89% for the 30-year.
So consistently above 6.5% for the standard 30-year loan. How does that impact the market?
Well, the sources are clear. These rates are a major obstacle for buyers. They use this really powerful analogy.
Yeah.
They say with today's financing costs, a $300,000 home suddenly feels like $450,000 compared to when rates were, say, 3%.
Wow, just the interest cost makes it feel that much more expensive.
Exactly. That huge jump in the total financing cost just makes buying unaffordable for so many more people, especially first-time buyers who really rely on getting a mortgage.
The monthly payment difference is just enormous. It prices people out.
Totally. And it reports, quote, experts saying, historically, a market might be able to handle high prices or high rates for a while, but it's really tough to sustain both for long. So high rates plus high home prices just kills buyers' ability and willingness to jump in, which feeds directly into those falling sales numbers we saw.
And what about people who already own homes? The ones who bought or refinanced when rates were super low?
Yeah, that's another critical point in the sources. Lots of Florida homeowners locked in rates in the 2%, 3%, 4% range over the last few years.
The golden handcuffs?
Exactly. They are really hesitant to sell because selling means giving up that incredibly low rate. If they bought another house, even a cheaper one, they'd have to finance it at today's 6.75% plus rates. Their monthly payment could easily go way up.
So unless they have to move, they're staying put.
Precisely. It's this lock-in effect.
Yeah.
And it really limits the supply of homes coming onto the market from those typical move-up or move-down buyers.
So ironically, that makes the market more stagnant, even though demand is falling, because the right kind of inventory isn't showing up.
That's the dynamic, yeah. Fewer existing homes listed by regular movers.
What about investors? How do high rates hit them?
High borrowing costs make buying investment properties, especially for rentals, much less appealing. The mortgage payment eats into potential profits from rent.
Right.
So investors buy less, which reduces demand and market liquidity. And investors have been a pretty big slice of the Florida market recently.
And I bet there's a psychological thing, too, with buyers seeing rates near 7%.
Oh, absolutely. Potential buyers might just decide to wait it out, hoping rates will drop later. That creates this kind of frozen demand, people willing but waiting, which slows things down even more.
Okay, so high mortgage rates are a huge piece, hitting affordability, locking in owners, deterring investors. But the sources point to another massive issue, one that feels especially sharp in Florida: the insurance crisis.
Yeah, this one is huge. Arguably the most significant factor, and maybe not cyclical like rates can be.
Yep.
The reports call it a catastrophic rise in insurance costs. And it's just fundamentally undermining affordability in Florida, maybe more than anything else right now.
The numbers you mentioned earlier were pretty jaw-dropping. Remind us.
They are stark. Florida homeowners pay the absolute highest average premiums in the U.S. In 2024, the average was about $6,000 a year, the national average, around $1,700.
6,000 versus 1,700. Wow.
And the 2025 reports, they indicate another average increase of 20% on top of that already high base.
So 20% on $6,000, that's another $1,200, pushing the average over $7,000 a year, just for homeowners insurance.
That's the average. The sources give examples where it's much worse. Average annual premium for a $300,000 home cited at 5,376 payments. But some homeowners are paying $600, $700, even $800 a month.
A month, just for insurance.
Yes. In many cases, more than their actual mortgage principal and interest payment combined.
Paying more for insurance than the loan itself. What is driving these insane costs?
The sources link it directly to the increased frequency and intensity of extreme climate events. Think hurricanes.
Right.
Western Florida got hit by 4 major hurricanes since 2022. Hurricane Ian alone in 22 caused an estimated $112 billion in damage. A huge chunk of that was insured losses. Then Helen and Milton in 2024 added over $4 billion more.
So bigger storms mean bigger payouts for insurance companies.
Exactly. And that's created a crisis for the insurers. They face massive losses, expect more severe weather. So many have gone bankrupt, pulled out of Florida entirely, or just refused to write many new policies.
Less competition means higher prices from those left.
Precisely. Homeowners have fewer and fewer options, so the remaining companies can charge these extremely high premiums.
Are there changes in how risk is calculated that are also playing a part?
Yes, definitely. FEMA's new system for pricing federal flood insurance, called Risk Rating 2.0, gets mentioned a lot.
Okay.
It's meant to price flood risk more accurately, but the result for many homeowners in flood-prone areas has been dramatic premium increases.
Like how dramatic?
Well, the sources give examples. The most affected ZIP code in South Florida, 33469, saw average flood premiums jump by 342% under this new system.
342%.
Yes, and in the most expensive ZIP, 33149 in Key Biscayne, average premiums are reportedly over $7,000 a year, just for flood insurance. That's on top of the homeowner's insurance.
So homeowners and flood insurance are both skyrocketing, often tied to this increase in climate risk.
Exactly. The sources are very clear on the climate change connection. It's not just hurricanes. Increased risk of flooding from sea level rise, changing rain patterns, even things like sinkholes potentially linked to weather patterns. It all creates huge uncertainty about the future financial risk of owning property in Florida.
Okay, so high mortgage rates, crippling insurance costs driven by climate, that's two massive storm clouds. What's the third major element the sources identify?
That would be the specific crisis hitting the Florida condo market. This is largely fallout from the new safety regulations put in place after the terrible Champlain Towers South collapse in Surfside back in 2021.
The post-Surfside regulations. Designed to prevent another tragedy, but how are they impacting the market now?
Well, the state passed much stricter laws, especially for older condo buildings. Key things highlighted in the sources: mandatory structural inspections. Buildings over 3 stories have to get a detailed inspection after 30 years. Or 25 if they're near the coast, then re-inspected every 10 years after that.
So older buildings get a thorough checkup. What's the financial fallout from that?
These inspections are uncovering a lot of deferred maintenance, significant structural problems in many older buildings. Fixing these things is expensive. And crucially, the new rules also require condo associations to have fully funded reserves for critical repairs.
Fully funded reserves, meaning?
Meaning they can't waive or underfund the savings needed for big-ticket items anymore. Roofs, structural elements, plumbing, electrical. They often did that in the past to keep monthly dues low. Now they have to have the money set aside or be actively saving it based on a reserve study.
So they need the cash for major future repairs.
Yes, and there's more transparency too. Law HB 913 requires associations to post meeting minutes online. so potential buyers can see discussions about needed repairs or potential assessments before they happen.
So buyers and owners get a clearer view of the building's financial health and future costs.
Exactly. But this combo, more transparency, mandatory repairs, mandatory reserve funding, is hitting owners hard financially. Costs are jumping, both through higher regular monthly dues to build reserves and through huge special assessments to pay for immediate critical repairs found during inspections.
How big are these special assessments owners are getting hit with?
They can be really substantial. The sources say they range widely, maybe $250 to $2,500 per month per unit, often spread over, say, 3 years.
Per month? Wow.
Yeah. So in some cases, the total hit for one owner from these assessments can run into the tens of thousands of dollars.
Tens of thousands on top of everything else. That must be crippling for some owners.
It is, especially the reports note for seniors or people on fixed incomes who maybe bought condos for affordable retirement. It creates real financial hardship. Plus, there's uncertainty future inspections might find more problems needing more money.
And the risk of the building itself being deemed unsafe.
That's the underlying fear. If issues are too severe and can't be funded, a building could be declared unsafe, leading to evacuations, maybe even demolition, a total loss of investment.
So owners face immediate costs and future uncertainty. How does that ripple through the condo market overall?
Big impacts. On the demand side, buyers are way more cautious now, especially about older buildings. They see the potential for huge assessments, rising dues, so they're demanding big discounts, or just avoiding older condos completely. That kills demand and pushes prices down in that segment.
And on the supply side, people trying to get out.
Exactly. Facing these sudden costs and future uncertainty, many existing owners are reportedly just listing their units. They'd rather sell now, even at a discount, than risk future assessments. So you get this surge of condo listings hitting the market.
So less demand, more supply, just like single-family homes, but driven by these unique condo issues.
Precisely. Leads straight to the higher condo inventory and lower sales volume we talked about. And there's another huge hurdle. Financing. Yes. Fannie Mae, the big mortgage backer, has reportedly expanded its blacklist of condo associations. Over 1,400 Florida associations are now on this list, where Fannie Mae won't finance loans for unit purchases.
Over 1,400 associations blacklisted. Why?
Sources say it's mainly due to inadequate insurance coverage, often tied back to that climate risk and insurer pullout, or because they have critical repair needs identified that haven't been properly funded or addressed under the new rules.
And if Fannie Mae won't back the loan,
then getting a conventional mortgage becomes incredibly difficult, if not impossible. It basically limits the buyer pool for units in those buildings to cash buyers only, which severely restricts who can actually buy them.
that's a huge chunk of the market, essentially cut off from typical buyers. This condo crisis really is a distinct, painful layer in this storm.
Definitely. Adds another major pressure point, especially hitting older buildings, often coastal ones.
Okay, high rates, the insurance nightmare, the condo chaos. Are there other factors feeding into this tough environment?
Yes, the sources also bring up demographic shifts and some broader economic factors. On demographics, while Florida is known for growth, the reports say the rate of growth is slowing and the mix is changing. Specifically, the state's organic growth is slowing way down.
Organic growth, meaning births versus deaths within the state.
Exactly. The birth-death rate is now below 1.0, below replacement level. Fewer births than deaths. The death rate is up substantially, reportedly 40% over the last 15 years, hitting 228,000 deaths in 2024. Meanwhile, births are down about 10% in that same period. And the median age has climbed to 43, an aging population.
So fewer births, more deaths. What about migration? That's usually Florida's big engine, right?
It still is a factor, and Florida still leads in people moving from other U.S. states.
No.
But the rate of people moving in has reportedly slowed significantly compared to the boom years. And, maybe more concerning, the sources point to significant outmigration from some areas.
People leaving.
Yeah. Like 67,000 people reportedly left Miami-Dade County in 2024. Statewide migration overall is said to have slowed by 80%. Projections estimate net daily migration will drop from about 972 people a day in 2024 to maybe 789 a day by 2030.
Almost 200 fewer people moving in each day by 2030. Why are people leaving places like Miami-Dade? Or why is the inflow slowing?
The reasons cited tie right back to what we've been discussing. The rising overall cost of living, those crushing insurance costs, and growing worries about weather risks and climate change impacts. These factors are reportedly making Florida less attractive or just financially impossible for some people, despite the sunshine and tax benefits. This hits the demand side, fewer potential buyers and renters coming in.
Fewer people moving in, some pushed out by costs,
Yeah.
shrinking the demand pool. What about bigger economic factors?
A couple of things mentioned. One is potential new tariffs on construction materials from places like Canada and Mexico. There's worry this could push up costs for new builds, but also for those essential repairs on older condo buildings. Another layer of expense.
Higher building and repair costs never helps affordability.
Nope. And general construction costs are already high from inflation. Labor shortages. Another thing is the behavior of big investment firms.
The ones who bought up houses to rent out?
Yeah, those large national firms that bought heavily when rates were low. Reports indicate they're now selling off some of their inventory. Data suggests maybe 1 in 10 homes currently for sale are from these investors. They're reportedly just not seeing the profitability in the Florida rental market anymore, likely due to falling rents, plus rising costs like taxes and insurance.
So investors flipping from buyers to sellers adds even more supply. It really is a perfect storm of factors. Okay, let's connect these dots. How do these individual things combine and amplify each other?
Right, this is where the real complexity shows up. It's not just one thing in isolation, it's how they interact, create feedback loops. Take the high inventory, for example.
Yeah.
When you have so many homes for sale, especially when demand is already weak from high rates and costs, it just totally shifts the power balance.
To buyers away from sellers.
Exactly. Sources say this flood of supply creates fierce competition among sellers. To attract the few buyers out there, sellers have to cut prices, offer concessions like paying closing costs, offering repair credits, or pour money into updates just to stand out. Buyers have tons of choice and leverage.
And seeing all the inventory pile up, prices starting to wobble, psychologically, that must make buyers pause, right? Wait and see.
Absolutely. Reports mention that effect. Buyers see the market softening, figure prices might drop more so they hold off, wait for a better deal. That waiting game slugs sales even more. Homes sit longer, which puts more pressure on sellers, especially motivated ones, leading to more price cuts.
And investors see this.
And they pull back from buying, maybe even start selling more, adding to supply again. So high inventory, maybe initially sparked by building and investor sales, becomes a driver of falling prices and slower sales itself.
It feeds on itself. How does climate risk weave into this amplifying dynamic?
Climate risk is. It's deeply tangled with the insurance crisis, and it's forcing a fundamental repricing of risk in Florida real estate. Like we said, more frequent, more severe storms mean huge insured losses. Think Ian's $112 billion damage estimate.
Yeah.
That sets off the chain reaction. Insurers face huge payouts, get unstable, leave the state, or jack up rates for those who remain.
Leading to those sky-high premiums.
Yes. And the sources stress this high insurance cost, driven by climate risk, is changing the market fundamentally. The combined cost rising homeowners insurance, plus potentially mandatory soaring flood insurance, especially with risk rating 2.0 and the new flood maps, it makes the total cost of owning many properties, especially in vulnerable spots, just astronomical. And that level of expense, the sources say, it's pricing out the average buyer, especially anyone needing a mortgage where the lender demands insurance.
So the market kind of splits based on affordability of risk.
Precisely. Owning property in high-risk zones, coastal areas, it's increasingly only viable for the wealthy or cash buyers who aren't forced by a lender to carry that costly insurance. It just shrinks the buyer pool for those properties, changing the whole market structure.
Let's drill down on those new flood insurance rules in FEMA maps. Sources suggest they're a game changer.
They really are. Beyond risk rating 2.0, changing how flood risk is priced, you've got new rules being phased in, mandating flood insurance for more properties via Citizens, the state insurer.
More people have to buy it.
Right, adding another big mandatory cost. And crucially, FEMA is updating its flood maps to firms across Florida through 2025. August to November are key effective dates. These updates are shifting thousands of properties from low-risk zones into high-risk zones, like AE or VE zones.
So homes previously thought safer are suddenly designated high risks.
Exactly, and that has an immediate direct hit on their value and desirability. The sources give this really stark example from Pinellas County. Properties inside FEMA high-risk flood zones, there saw prices drop 23% between November 2023 and April 2025. But homes in Pinellas outside those zones, prices were much more stable over the same time.
Wow, a 23% price hit just for being rezoned high risk. That really shows climate risk hitting value directly.
It absolutely does. The average federal flood policy might be $865 nationally, but in these Florida high-risk zones, It can easily be $3,500 a year, sometimes much more. And those premiums are rising about 18% annually on average. That huge unavoidable cost gets baked right into the property's value.
And that connects back to the financing problems, like the Fannie Mae blacklist.
Yes, strongly. High mandatory flood insurance makes homes in risky zones less liquid, harder to sell. Fewer buyers can afford the total PITI plus flood cost. And yes, that Fannie Mae blacklist we talked about for condos. It also includes properties or associations that lack adequate flood insurance coverage. Another barrier for buyers needing loans.
So the flood maps and rules are basically creating these tiers in the market. High cost, high risk zones dropping in value, harder to sell, and lower risk zones holding up better.
That's exactly the picture painted by the sources. The market is segmenting based on this priced climate risk.
Yeah.
High-risk properties might increasingly become the domain of cash buyers or the very wealthy who can absorb those costs.
What about the longer term view on this climate risk pricing?
The sources mention analysis, like from McKinsey, predicting huge potential devaluation, maybe $30 to $80 billion for vulnerable Florida homes by 2050, just from flood risk.
Billion with a B.
Yes. The example they give is Miami-Dade oceanfront properties exposed to extreme flooding projected to go from 5% vulnerable in 2019 to 98% by 2050. This growing awareness, this quantification of risk, it makes Florida less appealing for long-term investment, pushing some investors elsewhere or only into perceived safer inland areas.
It sounds like the market can't just bounce back to normal. It has to fundamentally adapt.
That's the strong implication. Adaptations will be needed, maybe developing more flood-resistant buildings, maybe shifting development patterns inland. The cost of climate risk isn't some abstract future thing anymore. It's here, now, priced into insurance, regulations, and property values.
Okay. We've looked at the numbers, the causes, how they interact. Let's look ahead. What do the sources forecast? Short term, long term?
Okay, short term, basically 2025 into 2026. Analysts generally expect prices to keep adjusting downwards. Economists quoted expect price growth to keep slowing or outright falling through 2025. Predictions are for statewide prices to drop at least 5%, maybe as much as 10% in the hardest hit areas.
Are specific areas flagged as especially vulnerable to price drops?
Yes, firms like CoreLogic have pinpointed some Florida metros. Winter Haven, Tampa, and West Palm Beach are listed among the top 5 U.S. markets with a very high risk, over 70% chance of price declines in 2025.
So more price drops expected, especially in those spots. How long is this rough patch supposed to last?
TD Bank economists are quoted predicting this complex situation, which really emerged late 24, early 25, will likely persist for about 2 years. So maybe through 2026, suggest a quick rebound isn't expected.
And in the condo market specifically, which seems to have its own unique set of problems.
Yeah, the outlook there is particularly cautious. Sources suggest the condo segment might only start to stabilize towards the end of 2026. And even that often comes with a big if.
Which is?
If mortgage rates start coming down,
Fair.
that would help affordability and maybe bring some buyers back.
What are the current condo trends showing that inform that cautious forecast?
Well, early 2025 data reinforces the struggle. Statewide condo sales were down year over year in March, though maybe only slightly, 0.7%.
Yeah.
But condo inventory, it surged 38% year over year. Massive jump.
Supply just keeps piling up.
Exactly. And the time it takes for a condo to sell increased to 48 days on average. Longer time on market, way more inventory, slower sales, all signals of a segment really struggling.
Are there differences within the condo market by region?
Yes, definitely variations. Broward County is called out as a clear buyer's market for condos, almost 11 months of inventory. Huge oversupply. Inventory there grew like 50% in the last year alone. Wow. Miami-Dade is also described as oversaturated with condo inventory, though maybe still below pre-pandemic peaks. Palm Beach County is mentioned as a bit of an exception. Actually saw its median condo price rise recently to $330,000, suggesting some local resilience.
So mostly struggle, but some variation. What about the financial strain on owners and associations? Any signs of that?
Yes, several indicators mentioned. Reports of rising delinquent payments on condo dues owners struggling. High turnover as people try to sell. Falling property values, especially in older buildings hit with big assessments. And roughly 6% of condo associations statewide are reportedly facing significant financial stress from repairs and funding rules. It's causing real hardship, what the sources call forced sales, particularly hitting seniors on fixed incomes.
Is there any upside in the condo market right now?
Well, one relative positive noted is that because prices have fallen or stalled, condos often remain more affordable per square foot than single-family homes. So, despite the risks and higher costs now, they might be one of the few options left for some first-time buyers.
Okay, that's the next couple of years. What about longer term, say 2027 to 2030 and beyond?
Longer term, the impact of those new condo safety laws is viewed cautiously optimistic, maybe?
How so?
While they're causing immense short-term pain, the goal and expected long-term result is positive. Mandatory inspections, required reserves, they should lead to better maintained, safer buildings over time.
So the turmoil now could lead to better quality and maybe restore trust down the line.
That's the prediction mentioned. Well-maintained buildings with solid reserves should hold value better, maybe even increase value, compared to neglected ones. The hope is stricter standards restore confidence eventually. So the overall long-term influence of the reforms is seen as potentially positive for value, despite the current mess.
But the climate factors, those aren't going away, are they?
No, absolutely not. Sources are clear. High insurance costs, the financial burden in vulnerable areas that's likely permanent. Experts call these climate costs a non-cyclical phenomenon.
Meaning not just part of the usual up and down cycle.
Right. They're expected to reset baseline housing values in Florida, especially in exposed spots. These costs are becoming a fundamental long-term feature of the market, permanently affecting valuations.
That McKinsey prediction, again, $30 to $80 billion in devaluation by 2050, really hammers home the long-term nature of this.
It does. Shows the financial risk of climate change is being quantified and expected to have a lasting impact on values and investment appeal.
Okay, so despite these major long-term pressures, what's the overall outlook for the Florida market into the late 2020s based on these sources?
Well, acknowledging the crisis and challenges, the sources generally offer a moderately positive view for 2025 to 2030. They predict a return to moderate growth.
Moderate, like what?
Forecasts are in the range of maybe 4% and 6% annual price increases towards the end of the decade. Goldman Sachs specifically predicts a 3.6% increase in median home prices over this period.
So not the crazy boom years, but still some growth expected. Why? What supports that?
The underlying factor is still Florida's population growth, even if it's slowing. The state hit 23 million residents in 2024. It's still a popular place for people moving from other states. That continued inflow, plus the lifestyle, the tax advantages, it provides ongoing underlying demand. That demand is expected to support the market and lead to moderate appreciation, kind of counterbalancing those big challenges we've discussed. So the long view seems to be cautious resilience.
Wow. We have really taken a deep dive into this source material. We've looked at the current state, the tangled web of causes, how they feed each other, and what the analysts see coming down the pike.
It really is, as the sources keep saying, a perfect storm. You've got the oversupply from building and investors selling, hitting weak demand because of high rates that crush affordability and lock owners in. Then layered on top, those crippling, non-cyclical insurance costs from climate risk. And the condo chaos from the new regulations, inspections, huge assessment.
Plus slowing population growth and people leaving because of costs and climate worries.
Yeah, all hitting at once.
It's clearly a tough time right now, especially if you're trying to sell or you're an investor or a condo owner facing those massive bills.
It is. But the sources also suggest for buyers who have been waiting, maybe priced out, this period of more inventory, stable or falling prices in some areas. It could present opportunities they haven't seen recently. The power has definitely shifted away from sellers in many segments.
And it sounds like this won't resolve overnight. It needs constant watching.
Absolutely. It's fluid, complex. Stabilization, especially for condos, might take until late 2026 or beyond. And even that depends on things like mortgage rates cooperating, which is no guarantee.
This whole dive really highlights how these big, seemingly separate things, global climate, federal flood rules, state condo laws, individual mortgage decisions, all crash together to reshape a huge regional market.
It's a powerful example of external risks and regulations translating directly into real market costs and impacts for property owners.
Which brings us to a final thought for you, our listener, to mull over, pulling all these threads together. If the true rising cost of climate risk is now being directly and significantly priced into Florida real estate through insurance, flood maps, mandatory building upgrades, is this difficult market just a temporary correction?
Or, as some analyses suggest, is this something more fundamental, a long-term resetting of baseline property values, especially for homes and condos right there in the vulnerable coastal zones?
And if it is a fundamental reset, what does that mean? Not just for property values, but for how and where people live, invest, and build in these popular, beautiful, but increasingly exposed places.
That's a question that's going to shape the Florida real estate story for a long, long time to come.